You need to see what's happening right now in the silver market. Because if you own silver, or you've been thinking about buying silver, the next few weeks could determine whether you make the trade of the decade, or watch from the sidelines as one of the biggest wealth transfers in modern history unfolds without you. Let me show you something that should make your heart race. Silver just hit record highs, breaking through levels we haven't seen in decades. But here's what nobody's talking about. This isn't just another bull run. This is the beginning of something far bigger, far more structural, and far more urgent than anything we've witnessed in the precious metals market in over 40 years. The silver market is entering its fifth consecutive year of supply deficit. Think about that for a moment. 5 years. That means for 5 straight years, the world has been consuming more silver than it produces. And it's not slowing down. It's accelerating. The Silver Institute just released data showing total silver demand reached 1.16 billion ounces. Now, you might hear that demand fell slightly from the previous year and think, well, maybe the pressure's easing. But that would be missing the entire story. Because while physical investment demand softened, industrial demand is exploding in ways that are fundamentally reshaping this market forever. Here's what's really happening. Silver is no longer just a monetary metal. It's no longer just an inflation hedge or a safe haven asset. Silver has become the indispensable metal of the modern technological age, and the industries that need it most are just getting started. Electric vehicles are consuming silver at unprecedented rates. Every EV requires significantly more silver than a traditional combustion engine vehicle. We're talking about silver in the electrical systems, in the charging infrastructure, in the battery management systems. The Silver Institute forecasts that global automotive silver demand will grow at a compound annual growth rate of 3.4% through the end of the decade. That might not sound dramatic until you realize we're talking about millions of vehicles, each one requiring more silver than the last generation. But EVs are just the beginning. Artificial intelligence is creating a silver demand shock that most investors haven't even begun to comprehend. Every AI data center, every server farm powering these massive language models and machine learning systems requires enormous amounts of silver. The electrical contacts, the thermal management systems, the high-performance computing infrastructure, all of it needs silver. And as AI continues its exponential growth, that demand isn't linear. It's exponential too. Solar panels are another massive driver. Silver is essential for photovoltaic cells. As the world races toward renewable energy, solar installations are breaking records every single quarter. Each panel requires silver paste for the electrical contacts. And here's the kicker. As solar technology improves and becomes more efficient, many of the new designs actually require more silver per panel, not less. Now let's talk about what this means for supply. Silver mining is not keeping pace. In fact, it can't keep pace. Unlike gold, where about 75% of production comes from dedicated gold mines, most silver comes as a byproduct of other mining operations. Copper, lead, zinc. That means silver supply is largely dependent on the economics of other metals. You can't just decide to mine more silver when the price goes up. It doesn't work that way. The lead time to bring a new mine online is 7 to 10 years. Even if companies started major silver exploration projects today, we wouldn't see that supply hit the market until the early 2030s. Meanwhile, existing mines are depleting. The easy silver has already been extracted. What remains is deeper, lower grade, more expensive to process. Here's where it gets really interesting. The paper silver market, the futures contracts, the ETFs, the derivatives, is enormous compared to the physical market. The COMEX, the major exchange where silver futures trade, has been operating on a fractional reserve system for years. There are far more claims on silver than there is actual physical silver in the vaults. For decades, this worked fine. Most traders never took delivery. They just rolled their contracts forward or settled in cash. But something is changing. Physical demand is surging. Industrial users need actual metal, not paper promises. And increasingly large investors are demanding physical delivery too. Watch what happened in recent months. Silver prices spiked to levels that triggered massive delivery demands. The COMEX had to scramble. Vaults that were supposed to be full suddenly looked a lot less full. And here's the thing about a fractional reserve system. It works perfectly until everyone wants their metal at the same time. Then it breaks, catastrophically. Central banks are paying attention too. While gold gets all the headlines for central bank buying, silver is quietly being accumulated by nations that understand what's coming. They see the supply deficit. They see the industrial demand explosion. They see the paper market vulnerability, and they're positioning accordingly. Let me take you back to 1980 for a moment. Silver hit $50 an ounce. The Hunt brothers tried to corner the market, and it ended in spectacular fashion. But here's what's different now. In 1980, that price spike was driven by speculation and market manipulation. Today, we're looking at fundamental supply and demand dynamics that are far more powerful and far more sustainable than anything the Hunt brothers could have engineered. In 1980, there was no electric vehicle revolution. There was no AI boom. There was no massive solar build-out. Industrial demand was a fraction of what it is today. And the supply deficit, it didn't exist. In fact, there were massive above-ground stockpiles of silver that could be dumped onto the market to crush the price. Today, those stockpiles are gone. They've been consumed by decades of industrial use. The silver that exists above ground is largely in the form of jewelry, silverware, and small bars and coins held by investors. It's not coming back to market unless prices go dramatically higher. Some analysts are now projecting silver could hit $100 an ounce, not because of speculation, not because of manipulation, but because the math simply doesn't work at current prices. When you have 5 consecutive years of supply deficits, when you have industrial demand growing exponentially, when you have a paper market that's over-leveraged, something has to give. And what gives is price. Think about what 100 silver means. If you own silver today at current prices, you're looking at potential gains that could double or triple your position. But here's the urgent part. The window to position yourself is closing fast. Why? Because the smart money is already moving. Institutional investors who spent years ignoring silver are suddenly paying attention. Hedge funds are building positions. Family offices are allocating capital. These aren't retail investors chasing momentum. These are sophisticated players with research teams and inside information, and they're moving size. When institutions start buying physical silver in large quantities, the market dynamics change overnight. Unlike stocks, where you can always create more shares or bonds, where governments can always issue more debt, physical silver is finite. When the big players start competing for available supply, prices don't rise gradually, they gap up violently. We're already seeing signs of this. Premiums on physical silver, the amount you pay above the spot price to actually get metal in your hand, have been elevated for months. Dealers are struggling to keep inventory. Mints are running at capacity and still can't meet demand. These are not the signs of a market with abundant supply. These are the signs of a market under stress. Now, let me address something important. If you're sitting on retirement savings, if you have $100,000 or more in traditional accounts, you need to understand how precious metals can fit into your wealth protection strategy. I've put together a comprehensive guide on gold IRAs, how they work, how to get physical metals into your retirement account without tax penalties, the custodians that handle this properly. It's in the description below. This isn't about abandoning your other investments. It's about diversification and protection in an environment where traditional assets might not perform the way they have in the past. Because here's what's really at stake. We're living through a period of unprecedented monetary experimentation. Central banks have printed more money in the last few years than in the entire previous history of their existence. That money has to go somewhere. It has to chase assets. And when investors start questioning the long-term value of paper currencies, they look for real assets, hard assets, things that can't be printed or created out of thin air. Gold gets the attention because it's the traditional monetary metal. But silver? Silver is the leverage play on everything that's happening. It has the monetary properties of gold, but it also has the industrial demand that gold lacks. When gold moves, silver typically moves further and faster. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 15 to 1. Right now, it's much higher. If that ratio reverts to historical norms while gold is also rising, the mathematics for silver become explosive. Let me paint you a scenario. Imagine you're an industrial manufacturer. You need silver for your production line. You've been buying it at current prices, and your business model works. But suddenly, silver starts spiking. Your procurement team is scrambling. You need to lock in supply, so you start buying forward contracts. But so is every other manufacturer in your industry, and the solar companies, and the EV manufacturers, and the AI data center operators. Now you're all competing for the same limited supply. Prices aren't just rising, they're surging. And here's the problem. You can't just switch to a substitute material. Silver's properties are unique. Its electrical conductivity, its thermal conductivity, its reflectivity. There's no perfect replacement for most applications. You need silver, and you'll pay whatever it takes to get it. That's the demand side. Now flip to the supply side. You're a mining company. You've been producing silver as a byproduct of your copper operation. Silver prices are rising, which is great for your revenue, but you can't just produce more silver. Your mine produces what it produces based on the copper ore body. To increase silver output, you'd need to find and develop an entirely new deposit. That takes years and hundreds of millions of dollars in capital. So supply is essentially fixed in the short to medium term, while demand is accelerating. This is the setup for a price explosion. And it's not theoretical. It's happening right now. The geopolitical dimension adds another layer of urgency. We're watching the global monetary system fracture in real time. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies. They're accumulating gold and silver. They're building alternative payment systems. This isn't conspiracy theory. This is official policy. These nations represent nearly half the world's population and a massive share of global GDP. When they move away from dollar-denominated trade, when they start backing their currencies with hard assets instead of faith in U.S. Treasury bonds, the implications for precious metals are profound. China has been particularly aggressive. They're the world's largest silver producer, and they're consuming more silver domestically than they produce. They're a net importer now, and they're not exporting their production the way they used to. They're keeping it, building strategic reserves, positioning for a world where silver is even more valuable than it is today. Russia, under sanctions and cut off from Western financial systems, has been accumulating precious metals as a way to preserve value and conduct international trade. When you can't use dollars or euros, when your assets can be frozen by Western governments, physical gold and silver become essential tools of economic sovereignty. This is the context that most silver investors are missing. They're looking at charts and technical indicators which are important. But the real story is the fundamental restructuring of the global economic order, and precious metals are at the center of that transformation. Let's talk about what happens in a supply squeeze. We've seen this play out in other commodity markets. Remember nickel in 2022? Prices went absolutely parabolic when a short squeeze developed on the London Metal Exchange. Trading had to be suspended. Contracts were canceled. It was chaos. And that was nickel, a metal with far more supply flexibility than silver. Silver is different because of the paper market overlay. There are so many derivative contracts, so many ETFs, so many claims on metal that doesn't physically exist in available form. When a squeeze starts, when industrial users and investors simultaneously demand physical delivery, the paper market can't deliver. Prices don't just rise, they explode. We saw a preview of this during the Reddit-driven silver squeeze attempt. Retail investors coordinated to buy physical silver and silver ETFs trying to force a short squeeze. The establishment laughed it off. But here's what they didn't tell you. It actually worked, partially. Premiums spiked. Dealers ran out of inventory. The COMEX had to adjust delivery rules. It didn't break the market, but it showed the vulnerability. Now imagine that same dynamic. But instead of retail investors, it's industrial users who absolutely need the metal for production. Instead of a social media-driven buying frenzy, it's a fundamental supply deficit that's been building for 5 years. Instead of a temporary squeeze, it's a structural shift in the market that could last for years. The clock is ticking because the market is already tight. Every month that passes with continued supply deficits means less available inventory. Every new solar installation, every new EV produced, every new AI data center built consumes silver that's not coming back to market. The buffer is shrinking. And here's the thing about markets. They don't move in straight lines. They sit quiet for long periods, lulling everyone into complacency. Then they move violently, catching everyone off guard. Silver has been in a consolidation phase for years. Most investors forgot about it. But the fundamentals have been building the entire time, like pressure in a volcano. When silver breaks out, and the evidence suggests it's already starting, the move will be fast and dramatic. You won't have time to research, to deliberate, to wait for a pullback. By the time the mainstream financial media is talking about it, by the time your neighbor is asking you about silver, the easy gains will be gone. This is why the urgency is real. This is why silver owners need to pay attention right now. If you already own silver, you need to understand what you're holding and what it could become. This isn't just a trade. This could be a generational wealth-building opportunity. If you don't own silver yet, you need to ask yourself, what am I waiting for? What additional confirmation do I need? 5 years of supply deficits? Check. Exploding industrial demand? Check. Record prices being broken? Check. Institutional accumulation? Check. Geopolitical instability driving safe haven demand? Check. The setup is there. The fundamentals are there. The technical breakout is happening. The only question is whether you're going to act or whether you're going to watch from the sidelines and regret it later. Let me be clear about something. I'm not saying silver only goes up from here in a straight line. Markets don't work that way. There will be pullbacks, there will be volatility, there will be moments of doubt. But the long-term trajectory, based on everything we're seeing in supply and demand fundamentals, points strongly higher. The difference between investors who build wealth and those who don't often comes down to timing and conviction. Having the conviction to act when the setup is right, even when it feels uncomfortable, even when the crowd isn't paying attention yet. That's how fortunes are made. Think about the people who bought Bitcoin at $1,000 and held through the volatility to $60,000. Think about the people who bought real estate in 2010 after the crash when everyone said the market was dead. Think about the people who bought gold in 2001 at $250 an ounce and rode it to $1,900. They all had one thing in common. They saw the fundamental setup. They had the conviction to act, and they had the patience to hold through the noise. Silver is setting up the same way right now. The fundamentals are screaming. The technicals are confirming. The smart money is positioning. The only question is whether you're going to be part of this move or whether you're going to explain to yourself later why you didn't act when you had the chance. The industrial demand story alone is compelling enough. The supply deficit story alone is compelling enough. The monetary debasement story alone is compelling enough. But when you combine all three, when you add in the geopolitical tensions, the paper market vulnerabilities, the institutional awakening to silver's potential, you get a perfect storm. And perfect storms in commodity markets create life-changing opportunities for those who position themselves correctly. They also create regret for those who see it coming and do nothing. So here's what you need to do right now. First, educate yourself. Understand what you're buying and why. Don't just chase price momentum. Understand the fundamental case. Second, determine your position size. How much of your portfolio should be in precious metals? That depends on your situation, your risk tolerance, your time horizon. But having some exposure is almost certainly better than having none. Third, decide on your vehicle. Physical metal, ETFs, mining stocks, each has advantages and disadvantages. Fourth, act. Don't wait for the perfect moment. Don't wait for a pullback that might never come. If the fundamental case makes sense to you, start building your position. The clock is ticking because markets wait for no one. The silver market is moving right now. The supply deficit is real right now. The industrial demand is growing right now. The institutional money is flowing right now. Every day you wait is a day that the opportunity potentially diminishes. I'm not trying to create false urgency. I'm trying to make you understand that real urgency exists based on what's happening in the actual market. This isn't hype. This isn't speculation. This is supply and demand economics playing out in real time in a market that's been overlooked and undervalued for years. The investors who recognize this moment for what it is, who understand the magnitude of what's unfolding in the silver market, who have the courage to act on their conviction, those are the investors who will look back years from now and recognize this as a pivotal moment in their wealth-building journey. Silver owners, the clock is ticking. The market is moving. The fundamentals are aligned. The question isn't whether silver is going higher. The question is whether you're positioned to benefit when it does. Because this train is leaving the station, and once it's gone, you won't get another chance to board at these levels. The choice is yours, but make it soon. Because in markets like this, hesitation is expensive and regret is permanent. The opportunity is here, the time is now, and the clock is ticking fast.